In this final video, let's talk a little bit about how do investors use this information? How do they utilize these statistics and the information about companies? So individuals and institutions use typically two kinds of approaches: a traditional approach and what's referred to as the modern portfolio theory. The traditional approach looks at basically trying to find a wide variety of stocks and balancing that portfolio. Since we're looking at a wide variety of stocks, there would be lots of different industries involved. They could be domestic, they could be international, but they would come from a broad range of industry. So we would get a very steep and a very deep diversification from the correlations between all those different industries. Typically, they're going to focus on well-known stocks for some very basic reasons. Well-known stocks are perceived as being less risky. They're certainly more liquid and readily available than other kinds of stocks maybe, and just their familiarity provides some comfort level for investors. Modern portfolio theory utilizes the statistics we've been talking about: expected return, standard deviation, correlations. Ultimately, they utilize beta, and they use these measures to find combinations of investments to ultimately try to define what the best portfolio could possibly be. So they want to achieve maximum benefits when we combine securities that are relatively uncorrelated, and we combine them together in portfolios. We talked about efficient portfolios earlier. So when we look at the set of possible investments, and they refer to the set as being the feasible set. That is, if you can imagine all the investments in the world and all the combinations of those assets in the world, you would get a graph that depicted the risk and return of every single one of those combinations. That's what's referred to as the feasible set. Well, an efficient frontier contains efficient portfolios. Efficient portfolios maximize returns for given levels of risk. So anything that's not an efficient portfolio is not desirable. In general terms, it's not desirable because there's something that you can get that is better than that. So here we have a picture of some different investments all put together, and we get this bullet-shaped curve. The efficient frontier is this dark blue line up here that represents the highest possible return for the least possible risk of an asset. Now, of all of these choices, the question we have is, which one will be best for an investor? And there's a concept in economics referred to as utility theory. And utility is nothing more than a measure of benefit, if you will. And the indifference curves are curvilinear. They're curvilinear because that's the way people think, right? It's a little bit beyond what this course is. But we have these curves. And as you move to the northwest here of this graph, we would be getting higher and higher benefits. So the graph, the line that touches the efficient frontier at only one point, that is point O, that is going to be the portfolio for this person that is going to create the highest rate of return given the risk that they're willing to accept. So again, coming back, the indifference curves indicate satisfaction or benefit. Every person has their own set of curves. The optimal portfolio then is that portfolio that provides the highest amount of return for the risk level that an investor in particular is willing to accept. So how portfolio betas come into play here is that that's the risk that we really want to measure, right? We want to measure portfolio beta because that's the only relevant risk. To maximize diversification, modern portfolio theory recommends you need 40 or more carefully selected securities. We need to put those together in a portfolio. Those securities, none of them will have a correlation with any of the others that is greater than +1. In fact, that's going to be closer to 0.5, maybe to 0.7 is the average correlation of stocks in the United States stock market. So when we combine this concept of portfolio beta, now we're measuring the right kind of risk. So to find the beta of a portfolio, it's the weighted average of the weights of the betas in the portfolios. So beta here, these are all the betas of individual stocks, and the W's represent the weights, the proportions that are invested in those betas. So if we show an example of that, again, we have this portfolio beta and return worksheet. Here we have portfolio V. Here are the weights invested in that asset. Again, you see it comes out to 1. Here are the betas of those assets. So when you calculate the portfolio beta, I know this says return here, but I hit a couple of columns that had returns in, so that's why that's there. The portfolio beta is 1.195. So we know what? This beta, this asset, is more risky than the stock market by almost 20%. So if the stock market were to go up, this asset portfolio should go up by about 20% more than what the stock market went up. So if the stock market goes up 10, this thing should go up 12, 20% more. In conclusion, we're coming to the end of this concept. And I will tell you that this chapter on modern portfolio theory, there are entire courses at the graduate level. There is an elective course at Thomas More that talks only about these portfolios and how you manage them, right? So the risk-return trade-off, right? We have to have a portfolio that has relatively risky investments to get a higher rate of return. We know that that's true. To earn more return, you have to be willing to bear more risk. Now, when we combine risky assets with the risk-free, again, we're going to get a portfolio that's going to be more diversified, but it will also have less risk. And since we're combining it with a T-bill, we might also be getting lower rates of returns. So as the risk of an investment portfolio increases from 0, the rate of return should increase above that risk-free rate of return. Now, how you can use the security market line requires just this short graph and a little bit of a description. The green line is the security market line. Essentially, the capital asset pricing model says if assets are priced correctly, they will be on this line. So all assets that are priced correctly, that are in equilibrium, if you will, in economic terms, should all be on this line. But look at asset C. Asset C has about the same amount of risk of A, but it has a much higher rate of return. How can it have a higher return at this same risk level? Well, the reason for the higher return is it has a very low price. So anything that lines up above the security market line, we would say is underpriced. These are the things that you want to buy. Down below here, those things that have lower returns than you would expect, the reason they have lower returns is because the stock price is too high. So anything that falls down here, if you owned it, you'd want to sell it. If you didn't own it, you would want to short sell it. And likewise up here, anything that falls up here, you would like to purchase. And if you owned it, you would want to hold it. So how do we reconcile these things together, right? The recommended portfolio approach uses parts of both approaches. We want to determine how much risk you're willing to bear. We need to seek diversification through a variety of types of securities and industries. We need to pay attention to correlations. Combining assets with high correlations is not as efficient at reducing risk as otherwise. We need to use beta to keep portfolio risk at acceptable levels. And then we need to evaluate these portfolios in total to select the highest return for the given level of acceptable risk. So it's a rather complicated process that utilizes both the traditional approach with some aspects of the statistical analysis that comes with the modern portfolio theory. So that's the end of our videos on modern portfolio concepts.